Mike Tedeschi, Portfolio Manager over at Perspective Wealth Planning. In today's video, we're going to talk about bear markets. We'll talk about what the definition the financial news media likes to give to bear markets, and then we'll talk about really what's important underneath of the surface. We're going to take a look at the 4 major U.S. indexes and look at some key levels that we touched on Friday, and we'll take a look at the U.S. dollar and some commodities as well. Now, that bear market definition is a 20% down draw from a high in anything, right? And the S&P 500 hit that 20% down draw level on Friday, intraday, and then rallied back up above that 20% zone. So the question is, are we still in a bear market because we're no longer underneath that 20% ratio? Well, I would say it's less important to define the market as bull or bear, but look at the market as healthy or unhealthy. And the thing that we like to look at in these videos is breadth readings, right? If more stocks are making new highs than are making new lows, then we've got leadership, we have the majority of things pushing higher, and that's a healthy market. When we have more stocks making new lows than new highs, that's an unhealthy market, and in unhealthy markets, bad things can happen. So let's take a look in at a couple of different breadth readings. Let's look at the New York Stock Exchange advanced decline ratio, okay? Now, the number of stocks making new highs peaked last October for the entire New York Stock Exchange and has been going down since that point in time, right? Yet from a technical standpoint, that 20% down draw ratio on the S&P 500 happened right here. But this was all unhealthy market behavior, and it's even more apparent when we take a look in at the Nasdaq. The Nasdaq, the advanced decline line in on the Nasdaq, topped out in the beginning of 2021. From this point in February 2021, we have had more declining issues than rising issues for well over a year. Are we only in a bear market come April of 2022 because that's when we hit the 20% down draw ratio in the Nasdaq? I think it's a lot more important to take a look at the health of the overall market here, and it has been unhealthy for a very long period of time. Now, what we're seeing is all of the bear market commentary and news reports here over the weekend because the S&P 500 hit that 20% level. What we really need to pay very close attention to is those breadth readings, those advanced decline lines. The last one we'll take a look at, which we take a look at every once in a while, is the Nasdaq Mcclellan Summation Index. We are back down to the levels that we had in the beginning of February and all the way back down to where we were in 2020 and in 2019, the taper tantrum at negative 1,000. This needs to turn and start going up before we can start thinking about a potential bottom being put in, or more importantly, healthier market conditions than what we're currently seeing. Now, what I wanted to talk about was we will have bounces along the way. This is how markets work. They do not go straight up. They do not go straight down. We have periods of upward movement. Then we get some back testing. Then we continue up, or, we fall lower. So it is healthy and normal to see bounces along the way. Now, let's look at the S&P 500, and what I want to put up on here is the fib retrace levels from the 2020 low all the way up here, right? We have had a move straight up, and then if we look at this as the top, and we look at a percentage of ratio fall back, the 38.2 fib retrace level was exactly where we got our bounce from on Friday, right? We pulled back to that first zone on a fib retrace and started to make a bounce. And the interesting thing is the areas of the market that were weaker also found support at a key fib level. Let's take a look in at the Nasdaq. The Nasdaq, we go from the 2020 lows up here. We found support right at the 50% retrace level, meaning we have given back half of the move we had on the way up. And that's where we started to find a little bit of support, or where we saw the bounce from last week. The Russell 2000, if we go from those lows to the high, we found support right there at that 50% level, that 1700. That also happened to be the major breakout level that we saw there in 2021, happened right at that 1700 zone. And even though we saw a lot of weakness last week, the Russell put the low in a week earlier and has stayed above that. And if we take a look in at the area of the market that has been the strongest, the Dow, we go from the low to the high here. We didn't even test the 38.2 level, which is back at 30,000. We started to bounce before that. Now, why is this important? I am not calling a low by any stretch of the imagination. I am saying an area where it makes logical sense to have a bounce is a zone that we're in right now, and it would not be surprising to see a counter trend rally after such strong selling. The Dow was down 8 straight weeks in a row. The last time that happened was 1923. The Nasdaq, the S&P, was down 7 weeks in a row. That is extremely rare to have happen, right? As I said in the beginning of the video, markets typically don't tend to go straight down or straight up, right? It is a choppier move. And after 7, 8 straight weeks down, falling into these important key fib levels, and the news media screaming bear market now, even though if we look at the health of the market underneath of the surface, it hasn't been healthy for a prolonged period of time. This does give the credence to this might be a zone where it makes logical sense to have that bounce. Now, the other things that we want to take a look at in this video are the US dollar, right? A strong dollar actually is a negative for commodities and for stocks. If it's, too strong, everything's priced in US dollars, it actually becomes a drag. Look at where we are. Monthly basis. Here's our monthly candle. We had the breakout. We're turning back down. We're now trading near the lows of that monthly candle. This could be viewed as a potential false breakout. The inability to close over that 104 on a monthly basis, and we could see some weakness out of the dollar. Now, even if the dollar doesn't break down, but just comes back to the angle that it was moving up, we could still see a pullback to 98 and not break that uptrend at all that's been in place from the last year. But that would give us a respite in these commodity, some of the commodities like gold and silver, which we'll take a look at in a second. And so that's something we definitely want to pay attention to. The other thing that we really want to watch is bonds. Bonds got crushed in the beginning of the year, and this was definitely starting to weigh on the growth areas of the market, with yields continuing to rise and rise and rise. Well, bonds found support right at a key level here from 2018, 2019. This is the 30-year bonds, and we pulled right into that level, and so far have started to make that bounce up. This, if we continue to head back up, and again, we don't even need to break the downtrend line. If we were just rallying back up here before rolling over again, we would still get relief for a few months as we rose back into that next resistance zone. There is a ton of resistance on this chart. It's not healthy in any way, shape, or form, but it looks like we are starting to get a potential bounce. If rates fall, the dollar starts falling, and the market holds these important fib levels, we could certainly see a counter trend rally here. Gold, let's jump in and let's take a look in on a daily basis here. Gold pulled right back to the lows of the year in at the 1780 zone and started to turn back up here over the last few sessions, right? We come in and we take a look at silver. Silver broke below the lows and is now trying to get back up above them. A move back over this 22 zone. This could be that false breakdown. And we come in and take a look at some of the other metals. Palladium sitting right at that 2000. Platinum, we're looking at a potential move back up over really a 980, 990 zone. And that would be a little bit healthy because it's pulled again into this area of support and held it. Now it needs to move in the opposite direction. We come in and we take a look at copper. Copper pulled all the way back down after that potential false breakout there in February, all the way back down to that $4 zone where it found support and it's starting to bounce, right? This chart has not broken either. All I'm trying to say from this video, guys, is there is a lot of reasons why this could be a zone where we see a bounce. It would be a counter trend rally. We are still in a downtrend in any way that you take a look at that, right? A downtrend being defined as a series of lower highs and lower lows. Well, here is a series of lower highs and here is a series of lower lows, right, that we've put in here on the S&P 500. We need to get back up over 4,100 before we can even talk about saying that that has been negated. And the big level is from the Fed 4300 rejection level. If we can get back up over these zones, then we have something else to talk about. For right now, we found a little bit of support in a downtrend, and we have a couple of reasons why this might be a level that holds. Bottom line, if we can't hold last week's lows, all bets are off, and we would be looking at something like the S&P 500 falling back to that 50% retrace level around that 3,500 zone. As always, I hope this information was useful for you guys. If you have any questions, feel free to reach out to me at mtedeschi@perspectivewealthplanning.com, or you can reach me at 814-580-9881. Stay safe out there, guys. I'll see you all tomorrow. Take care.